Good afternoon and welcome to the BMO Global Smaller Companies PLC Portfolio Positioning and Outlook Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. It can be submitted any time via the Q&A tab situated in the right-hand corner of your screen. Simply click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Peter Ewins, Portfolio Manager, and Christine Cantrell, Director and Head of Investment Trusts. Good afternoon.
Thanks very much. So just before I hand over to Peter, I just want to say, Christine Cantrell, I'm in charge of the sales and distribution of investment trusts at BMO Global Asset Management, which is now part of Columbia Threadneedle Investments, and combined, we are now one of the top 10 UK asset managers, and we have a team dedicated to helping shareholders such as yourselves, and we are really keen to hear from you today, so looking forward to receiving lots of your questions. So Peter Ewins is going to talk through the overview of the portfolio and his strategy and outlook, and very keen as well to answer your questions. He's been the lead manager on this trust since 2005, so very well placed to talk you through it. So thanks very much, and over to Peter.
Thanks, Christine, and thanks everyone for joining. I appreciate it's a very busy time for everyone at the moment and a lot to think about. I'm going to rattle through this presentation quite quickly with apologies, basically because there's so much to cover that, and I want to get on to your questions really from the point of view of, I think that's really what this is all about, trying to hear questions from the investors, and I'm very pleased to join this this format. I think it's a good new format to work with, to communicate with retail investors. So without further ado, moving on to slide 2, there's the usual sort of risk slide here. I'm not going to dwell on that. I'm going to take it as sort of read. The third slide, just to set out what I'm going to cover in this this presentation, really a little bit of a background to the fund, just quickly what the fund's all about. Then I'm going to talk about the 2021-22 financial year to date. That is a period of 9 months. We're an April year-end company, so the 9-month period to the end of January is what this presentation is really covering. But obviously, there's been a lot going on in February and in March so far, so I'll be commenting on what more recent events have done to the portfolio and how we're positioned, as Christine says. And really, this is about the strategy of the fund looking forward, rather than going through a lot of ancient history. So without further ado, I'll move on to the next slide, which is the overview of what this fund is aiming to provide for you. And I think ultimately it aims to do what it says on the tin. It's a global smaller companies investment trust, and we're aiming to provide exposure to investors, retail investors or institutional investors, or to the smaller companies universe globally. So we're not a UK focused fund. We're investing in smaller companies across UK, North America and Europe directly in individual stocks. And then we're using individual funds, collective funds as well, as we call them, collectives, to get exposure to Japan, Asia and the emerging markets, where historically BMO has lacked dedicated large small cap teams. So we've used third-party managed funds for those parts of the portfolio over the years. When we're looking at the individual fundamental stocks in North America, UK and Europe, I do benefit from working with a number of very experienced colleagues. There's some mugshots in the appendix later on, which you can look at, but ultimately a lot of people on the team and a lot of people that have got a lot of experience in making smaller company investment calls. The board of the fund has acted over the years to react to demand, supply imbalances in the stock. So for a number of years, the fund was issuing new shares into demand for shares at a small premium to NAV. More recently, in the last couple of years, we've seen the shares going back out onto a discount, and you'll see from published announcements the company has been buying back its own shares. Both sides of the equation ultimately enhancing NAV performance by issuing at a premium and then buying back at a discount, and that you should expect to continue all the while the shares stay on a wideish discount. And then the final point, this fund has got a long-term track record. I think it was launched in 1889. It hasn't been a smaller companies fund for that long, and I've not been a manager for that long, but I have been the manager, as Christine says, since 2005 and worked on the product prior to that from about 1997. So, there's a lot of people involved with the fund, but the trust has got a long-term track record, and we're very proud of that 51-year dividend growth record, which really stems from investing in growth companies on the portfolio that themselves can deliver growth. So that's the overriding, the headline. The next slide's got you some discrete performance. These are the sort of performance over discrete periods, 1-year periods. The last period on the left-hand side to the end of January 22, you can see the NAV over that period was up 14.1%, the share price a bit more, and the benchmark was 10.6. So we were outperforming over that 1-year period. I think that, as I said before, there's been a lot happened since then. So you've seen the markets pull back in the last month or so for reasons that we're all probably pretty well aware of. But over the last 12 months, over that 12 months period, we did have a good period of performance. Moving on to the next slide, just quickly, this is the portfolio structure as at the end of January. You can see on the left the geographic split. Now, broadly, this doesn't change all that much month by month or day by day for sure, but the UK and North America are being very long established equity markets, US market in particular, and the UK market. We have tended to have about 2/3 of our exposure involved in companies listed on those markets. Good corporate governance, good long-term track records of companies listed on those markets, and much more of a track record than maybe you find in Asian markets or in some other parts of the world. So you will find this fund has got a large exposure to those markets. More recently, we have been adding to our Japanese exposure a little bit. We put a bit more money into Japan there. You can see at the top, just over 7% now, the assets in Japan. That market had lagged last year, and we felt that was going to become more attractive in a relative sense. So we've added there. Looking on the right, I won't dwell on this too much detail at this point, but over the last 9 months or so, we have added to our industrials exposure and our financials exposure on the fund. Those sectors, we found more valuation attractiveness in those sectors. Against that, we've taken money out of technology and healthcare, where these sectors have been very popular in the last few years, and some of the stock valuations got quite extended. So we've reduced exposure over the last year to technology and healthcare. You can see the collectives there on the right. 18% of the fund is in these collective funds for Japan, Asia, and emerging markets, and I've got a slide on that in a few minutes' time. When we look at the next slide, this is actually just a bit just to dwell on this very quickly. These are all names that we were holding on the portfolio that have been taken over in the or that have had offers made for them in the period to the end of actually this runs now to the end of February. So you can see a lot of names on that slide. A lot of UK listed companies have been taken over in the last 12 months. In fact, even less than 12 months. A lot of private equity deals and a lot of larger companies making offers for these smaller companies on our portfolio that were fundamentally too cheap. And we think that will continue. We think we've had bid from Mackay Securities only in the last couple of weeks there on the bottom of the row there. We think that's going to continue, albeit the current geopolitical uncertainty around the conflict in the Ukraine is probably going to hold some of that back in the present environment. But it has been a very busy time for M&A on the portfolio, particularly in the UK there. The next slide talks about our weightings against our benchmark. So we have a benchmark which is effectively a sort of a set 30% weighting to the UK, and then 70%, the other 70% of the benchmark is the international markets. Relative to that benchmark, you can see we're overweight in Europe. We've been overweight there for a number of years. Actually, it's not the largest part of the portfolio, but it's an area of the part of the world where we found attractive valuations. So overweight to Europe, underweight to the UK by a couple of percent, but actually a higher weighting to the UK than we have had in the last couple of years, because not least because the UK portfolio has done quite well in the last period. So that has pushed its weighting up in the fund. And we've benefited from some of those takeovers, as I mentioned. Then quite neutral to the other markets. And I'll come back to say a few more observations about allocation as we go towards the end. The next slide really looks at the top end of the North American portfolio. So there on the left-hand side, these are the individual stocks that the portfolio holds in North America, mainly US, but some Canadian stocks on the North American portfolio. I'm not going to go through those names. We just haven't got time to go through these stocks. But ultimately, on the right, you can see from a sector point of view in North America, overweights to basic materials and industrials, some of those more cyclical areas, but also some areas like infrastructure within basic materials. So Eagle Materials is a cement business and other building products business there on the left. That's, we're quite positive on the outlook for infrastructure spending in the US and also elsewhere. So we've got a good weighting to that. We've got a good weighting also to some commodity stocks in North America, a couple of gold precious metals businesses that we're holding, for the current environment, of inflationary times we're now looking at. We think those will do quite well. And then just at the bottom, you can see we're underweight to healthcare, and that's been something that's benefited us in the last period of time. The portfolio in North America has outperformed significantly, at least in part due to that underweighting to healthcare. And healthcare in North America, there's a lot of riskier stocks within the biotechnology space that have sold off very heavily in the last few months. So you can see that is an area that we're underweight to by dint of not having exposure to the biotech sector directly. We tend to hold healthcare services companies in North America and have done very well in a number of them. And to that point, on the next slide, we've got the top contributors over the 9-month period. I mean, it's a bit historic now, the 9-month period to the end of January, but you can see their top 10 stocks. You won't probably be familiar with many of those names, but MaxLinear at the top is a home connectivity technology provider, done very well in the last couple of years of pandemic impacted life and benefited from increased spend of people to upgrade their home internet services, etc. The third one I'd mention as well, the Andersons, not a very well-named name, but that company is involved in the agricultural sector. And we certainly feel quite positive about the outlook for US agriculture looking forward, given the geopolitical situation we have in the Ukraine. Again, we'll come back to that, but ultimately that company is going to benefit hopefully from a better US agricultural demand scene. On the bottom end of the page, these are the stocks that didn't do well for us. They're always, by definition, going to be 10 bad ones on the bottom 10. A mixture of things there. A couple of things that I'd mentioned. Ollie's Bargain Outlets, the third one down. That was a pandemic beneficiary, a company that did well during the early stages of the pandemic, but actually has run into tough comps. It's a retailer in the US market, had some tough comps more recently, and the market has derated the shares as its sales have looked weak relative to a year ago. And then a company further down called Cerence, which is an automotive technology business. That was a star performer in the previous year, did really, really well. And I'm pleased to say we took a lot of profit in it. But more recently, it's had a few issues, and we have actually exited that company. You will see, just very briefly, you will see a number of a slight anomaly there. Maybe you think, what is that all about? Avis Budget on the bottom near the bottom of the page there, an active weight of -0.2. That means that we don't hold that stock, but it's actually in the index, and it did very well. It was up 100% and 102.9% in that period. So it hurt our relative performance. So there are one or two anomalies, and that's more evident actually when we come onto the UK, which I'll now move swiftly onto. The UK top end of that portfolio there, some of those names possibly more familiar to you. Pleased to say that, pretty much without exception, all those stocks are performing well. The companies are doing well. Sana Group and Clipper Logistics more recently both been subject to takeover bids. But all of the others, to varying degrees, performing well in the last couple of years. And doing good jobs in their individual areas. Next 15, a media services business that's really done very well and outperformed expectations considerably in the last couple of years. On the right there, you've got the sector weightings in the same way I had for the North America. Different sort of position there. We're underweight in financials where we're actually underweight in particular to banks. There's a couple of funny, in the UK small cap sectors, a couple of banks within the UK listed sector that are actually Georgian banks. And by Georgia, I mean Georgia next to Russia. We've avoided those forever. And I think at the moment in the current geopolitical situation, we'll continue to do that. We're also underweight to insurance stocks in that UK market. The car insurance market, underwriting profitability outlook has deteriorated a little bit, and we're also light in the Lloyd's insurance area. So that sort of explains that underweight. And then on the overweight side, overweights for a couple of niche healthcare businesses, and some of the consumer discretionary stocks, including something like a Watches of Switzerland, which has done really, really well as a luxury watch provider in the last 12 months. If I move on to the next slide just quickly, this is the top contributors and the bottom contributors in the UK. And again, you'll see some things there at the top of the list. You've got Cineworld, CMC. We've got negative active weights in them. That means we don't actually hold those stocks, and they did really badly in that 12 months period. The big contributors I mentioned, next 15, Watches of Switzerland, really good performance for us. UNI Group a little bit further down, that was taken over. Sane Group taken over, and One Savings Bank, OSB, just performing well, and was a big holding for us. So, a number of good things there. There's always casualties, unfortunately, in the small cap sphere, so we have to hold our hands up and say IG Design, In the Style, and Go Ahead, the train operator, have had very difficult periods. I could talk about them at length, but I'm not going to. I'm going to press on to the next slide. But ultimately, those stocks have had issues, and we have actually exited Go Ahead, and we're hoping the other two recover. The next slide, looks at Europe, and the same sort of way. We've got the European portfolio, and I'm not even going to try and pronounce that first one. The Danish, it's a Danish listed bank which has done really well actually in the last year. Banks have been re-rated as the interest rate environment has changed, and that company is doing a good job of consolidating the Danish banking scene. You'll see further down, actually, on the next slide, you'll see another Scandinavian bank called Spara Bank, which we own, Norwegian listed bank. That's done really well. But a whole mixture of other stocks in that top 10, different range of things, from industrial companies to IT, Nordic Semi, very, very successful niche semiconductor business has done really well. And that does feed into an overweight position on the right, you can see on technology in Europe, overweight to consumer staples as well. But on the other hand, underweight to real estate, where we've not really got very much exposure to that sector at all in Europe. If I move on to the next slide, again, these are the European winners and losers. And I think, I've mentioned the Danish bank at the top there, just a mixture of different things there. MIPS is a good one to talk about. This is a cycle. For those cyclists amongst you, you might find that your helmet has got a MIPS protective system within it. Helps to protect cyclists who fall off their bikes from damaging themselves any more than is necessary. And that company has, got a global lead in its market. And I think that's what we like to see in our companies. We like to see companies with really genuine, strong market positions in what they do. That's been a really strong performer over the last 12, 24 months for us. Then on the bottom side, some losers there. Global Fashion, unfortunately, is a business that was suffering before the Ukraine situation blew up, but it has got an exposure to Russia through it's an online fashions business, and it does sell in Russia. So that obviously has not helped in the last few weeks. I'm going to press on, but obviously, hopefully, I'm happy to take questions if anyone has any on individual stocks later on. The next slide really is just covering the collectives, the holdings that we've got for those Japanese, Asian, emerging markets parts of the world. A couple of points here. I think Eastspring is the largest. Eastspring Japan Smaller Companies Fund is the largest investment. That is a value-orientated approach. Actually, it's a fund that's run by a team who actually focus on buying really out of favour, unloved Japanese stocks, and over the long term, it's got a very strong track record. Now, you're probably aware that in the last few months, there's been a trend towards value away from growth in the markets. And that fund has, over 2021 and start of 2022, has performed really well for us. So that's been pleasing. Other funds that have done well more recently, Utilico Emerging Markets, that fund which invests in utility and infrastructure type assets in the emerging market spectrum, that's performed well for us in the last period, holding up well in the sort of more recent sell-off. Against that, some of the other funds, more growthy funds like the Baillie Gifford Japan Smaller Companies Fund, for example, or the PineBridge Asian Fund, the second one down. Those funds have had more difficult time as we've seen, a trend away from growth stocks. But generally, this list of collectives is quite steady. We don't tend to trade it all that much, but we're always on the lookout for interesting new funds to put on the portfolio. And so it's very much not just neglected. The next slide talks about, just some highlights again in strategy. So as I said earlier, we have run with a higher UK weighting more recently than we have done in the previous couple of years. I think that just stemmed from the view that there was value in the UK market, and I think we saw that come through in the last 12-month period with all these takeovers and just generally better performance from the UK equity market and the small cap and large cap end. We've added, as I said, to industrials, financials, where we found some valuation upside, and more recently to consumer staples, where if we're looking at a more need to be a little bit more defensive, then consumer staples may be a good place to hide in more difficult times. As I said before, we've reduced technology, healthcare. We also trimmed basic materials, some of those infrastructure plays that have done really well, actually, that we've taken a bit of profit on. The next one along, we have taken some money out of some more higher market cap stocks. So there's no rigid rule on this fund in terms of what's a small cap, what's a large cap. But when a company becomes $20 billion plus in market cap terms, we will tend to look to exit that stock. Unless we've got a very compelling reason that there's another leg up in it. We're probably going to look for the smaller version because this is a smaller companies fund, and you don't want to be owning a lot of mega cap stocks on the portfolio, I don't think. More recently, strategy-wise, we're obviously very, very conscious of the changing dynamics in terms of interest rate outlook, inflation outlook, and the impact on individual companies. So we've really been redoubling our due diligence in terms of our interaction with companies, trying to understand how they're going to perform in an era of higher inflation and higher interest rates. I'll come back to that in a minute. But gearing's on the fund is generally fairly modest, but we tend to be geared to a modest extent, and currently about 4%. The next slide, I'm not going to go through this in detail. These are transactions that either buys or adds. Some of them are just top ups, but these are stocks that we bought or added to in the last in the period to the end of January. You can see a lot more names in the middle section there, and that's the UK, where we found a lot of ideas in the last period in the UK. Partly because we've sort of had to, if you like, because some of the takeovers that we've had, the extended number of takeovers we've had, we've needed to replace those with some new ideas. And I think we've just come across a number of new holdings that we've really been quite interested in. One of the things I looked at more recently was Hotel Chocolat, and we took a holding in that, and that company is trading very strongly. A nice little niche small cap that's got a really good management team and has got an opportunity to grow globally in US and Japan in particular. So there's always things coming into the portfolio, and both also in North America and in Europe, a healthy number of things that we found attractive to put onto the portfolio. But in the interest of time and to get your questions, I'm going to move on. The next slide is talking to the sales. So obviously, if you're buying things, you're going to be selling things as well, and a lot of things there. But as I said, there are quite a few of those UK names: Stock Spirits, Vectura, Arrow Global, Viva Energy, Augean. Those companies all taken over in this period. So they've disappeared from the portfolio because they've been acquired by other entities. We've also had a couple of takers in North America that are featured. So QAD, the second one down there on the left, and you can see actually just quickly the third one down on the left. You can see we have taken some profit in Max Linear, which I mentioned earlier as being the best contributor in North America. So we've taken a bit of money out of that on the run. And Icon, the top one on that left hand side, that company just got too big. It's got a very large. It did an acquisition. Made it even bigger, so we've exited that holding and put a smaller company in, which was on the previous slide, called Syneos Health there. There on the right, in Europe, Just Eat Takeaway was a company we lost faith in and actually sold out of, and it's actually continued to it's dropped away quite sharply since we exited, actually, which is fortunate. The next slide really just looks at I'm just going to very quickly run through a couple of individual stocks that we have bought in the last period, just a little more detail. Kirby is a North American listed company. Picture sort of showing one of its vessels on the coast of North America. They ship a lot of petroleum products around. They ship a lot of products around to serve the onshore oil industry in North America. And I think we would probably feel certainly at the moment that the outlook for North American energy production has improved as a result of the geopolitical situation we find ourselves in. And companies like Kirby, which serve that industry, have certainly found that investors are more interested in them. Not just us, other people are buying into these sort of companies, energy services businesses. And I think, it's a company that we've actually held in the past on a couple of occasions successfully. And we bought into it last year, actually pre the recent situation developing. We bought it. We thought it was attractive value last year, and we think its prospects have probably been enhanced by recent developments. So we think that one's got the potential to actually benefit from a strong earnings recovery in its business. And it also has a good asset backing in terms of the value of the vessels that it uses to ship these products around. The next one, probably familiar, more familiar to you maybe, Capital & Counties Properties. Picture of Covent Garden there. They own a lot of the property around Covent Garden. It's a company that I'm responsible for putting this one on the portfolio. We met the management in early January, actually on a call, and fairly evident at that point in time that valuations of West End property were on the turn up. We think fundamentally the thesis is that actually Covent Garden as a shopping destination is becoming, is actually becoming better relative to Oxford Street within central London. A lot of Oxford Street's quite tired now, a lot of empty shops there, and a lot of people are now more gravitating towards a better shopping environment, pedestrianised environment around Covent Garden. A lot more interesting shops around there, and this company is standing to benefit from that and hopefully see a big recovery in its rental income. Notwithstanding the fact that retail property is, has challenges from the online, transition that we're all familiar with. But ultimately, we think this company is going to benefit from better rental growth and therefore better valuation of its properties. And you're buying the shares at the moment on quite a wide discount to NAV. So quite positive on that. And it does also illustrate a little bit of a theme as well at the moment for us, that we are quite interested in buying into or increasing our positions in companies that are beneficiaries of the end of the pandemic, which I think we've all sort of slightly put to the back of our minds. But touch wood, let's hope that the pandemic, the worst of it, is behind us, and normalization, if you like, of people movements, and will help a company like Capital & Counties, which will benefit from increased footfall and hopefully eventually a return of London tourists to the London market. The next one, Thule Group. Again, some of you might be familiar with this one. They make their biggest product is probably the bike rack or the cargo rack that you put on the top of your car when you're going on a holiday. Ultimately it's playing the sort of theme of the camping sort of theme, if you like, as well, with products that it sells into that market. Fundamentally, it's a business that my colleagues looked at for a number of years, and the valuation historically has always been quite high. It's pulled back in this most recent sell-off, actually, particularly again in the last couple of months. There's been quite a big de-rating this stock, and we've added to our holding in it more recently. Fundamentally, really well-managed company with a good ESG story to it, a good sustainability story, playing the health and wellness scene, and also got a good sustainability side to its story in terms of its sourcing. So, that one we think can grow long term, and it's a nice global business. The next slide, I think this is where I'm going to almost sort of pause, to be honest, because the other slides after this are the appendix with just some more information about the fund, which I'm not going to propose to go through. But just from overview, I mean, ultimately, we are expecting the economy still to grow. The current terrible, tragic Ukraine war situation is clearly going to upset the slow down growth, particularly in Europe, from what we would have hoped a couple of months ago. But the economy globally is still recovering. We all know that rising energy, food and other commodity prices are a big challenge for the markets and also for consumers. And how will governments react to that? Time will tell. Will some of these commodities, start easing if were there to be an end to the conflict? Again, time will tell. But clearly there's a challenge for companies to manage their margins in the current year. And that's why we're spending more and more time talking to companies about their cost structures and looking at their historical track records of how they've managed to hard inflationary times in the past. I think more positively, I'd say there are more opportunities now out there on the markets at a lower valuation point that we we can get into. So there are things for us to buy, but we have to be careful in the current environment, given the geopolitical risk that there is, and given ultimately the US are about to put rates up probably tomorrow. So there are headwinds to the market, as you all know, but we will spend our time, as we always do, looking at the individual companies, interacting with the management teams, and just assessing how they're going to perform in the coming years. The Ukraine situation, obviously at the bottom there, uncertainty around that, and we just hope to God that conflict can be brought to an end as soon as possible, and that Ukraine can be a free country again, as soon as possible. We're obviously conscious that current situation is impacting sourcing of materials for a number of businesses. But I think at that point, Paul and Christine, I'm gonna sort of pause and then hand back to you.
That's fantastic. Peter, thank you very much indeed for such a comprehensive presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the right-hand corner of your screen. But just while the team take a few moments to review those questions submitted today, I'd like to remind you that the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. Christine, if I may, you can see we've received quite a few questions that have come through from investors, and thank you all for submitting those. If I could just hand back to you, and where appropriate to do so, if I could ask you just to read out the question, that would be wonderful. Thank you.
Of course. And yeah, I agree. There's a lot of questions and very interesting ones at that as well. So I'll start off with some of the pre-submitted ones, even though, Peter, I think you have covered a lot. Well done. A mean feat getting through such a comprehensive level of information. So the first question, though, is really around the topic of Ukraine, because they're asking, have events changed your broad view of opportunities? Do you decide to trade in the portfolio based on these kind of geopolitical events?
Yeah, I mean, I think we don't like to think of ourselves as trading, really. I mean, I think I think when you're in a smaller companies fund and when you're a smaller companies manager, you have to really be looking to take a medium-term view, because liquidity in some of the investments is so much lower. So I think we are very reluctant at any point in time to trade and try and make a short-term turn on something. But obviously, as I said, we have to reflect on what does the Ukraine situation mean. I think our view would be that the outlook for going back to where we were a couple of months ago, even in the event of a ceasefire, I don't think we're going back to where we were a couple of months ago. So I think that does mean that in certain areas where the world currently gets a lot of oil and gas and some other commodities from Russia, and food, from the Ukraine, and even automotive parts, as we found out from companies from the Ukraine, the supply chains being such as they are today. I think some of those areas we have to accept that. I think we're going to have to, the world is going to have to get used to actually supplying more oil and gas, fossil fuels from outside of Russia, and so that does make us sort of feel that, as I said, sort of alluded on the way through, that companies serving, say, the North American energy scene are probably going to be benefiting from that, because there's going to be more attention. There's got to be more production from these other parts of the world if we're going to reduce the amount of product that we're taking in from Russia. But I don't think we want to second guess how things are going to move forward too much. But we certainly feel that this situation obviously lifts the whole inflationary outlook for a lot of commodities. And again, as I mentioned on the way through, food, again, North American agri, probably going to do well. Even European agricultural businesses are going to do well, because there's going to be an attempt to plant more crops in areas outside of Russia and the Ukraine. Defence companies, it sort of feels a bit sad to be saying it. There's some of these sort of areas that I think a lot of us were probably hoping we were going to have less involvement in defence, energy, and these sort of areas, but ultimately defence is going to be stepped up. In Western Europe, Germany's going to double the amount of money it's spending on defence. So we have to take all these things into our consideration when we're looking at our, what we're doing on the portfolio. And I think at the margin, I would say we're putting more money into companies with a good exposure to North America as opposed to Europe at the moment, because Europe is more impacted economically from the current events. So companies which may be listed in Europe that have a good exposure to North American the economy, then they're probably going to be holding up better.
Great. So I'm going to try to combine two questions. One is about diversification, but then another one is about how do you narrow down a very wide universe of stocks to get to the portfolio, and how do you decide to sell or reduce exposure to a stock? And then I'll add to that by saying, and how do you ensure you're diversified enough as well?
Yeah, so it is. So I've sort of said that it is a diversified fund. I mean, we have we actually got a total of about 180 individual equities in North America, UK, Europe. So if you like, you've got a UK smaller companies portfolio about as long as what you find in an individual UK small cap fund. You've got a North American fund that's about as long as you find in a North American fund, so bolted together. So there's the diversification from that. And then you've got the collectives, which obviously themselves are diversified. So it is a diversified fund, but that's not to say we're just diversifying for diversification's sake. We are looking to, as I said a minute ago, we're looking to skew the portfolio to certain sectors that we perceive to be more value in. So I said we've taken money out of healthcare and tech in the last 12 months because we felt the valuations there were running ahead of themselves in some cases, and put more money into some of the more out of favour areas, maybe the financials or some of the industrials, I said, that were looking cheaper. So at any point in time, we're doing a bit of rejigging in terms of the weightings, but this fund will always be pretty well diversified. I think another part of your question was, how do we decide when we sell or reduce stock? I mean, ultimately it comes down to the team. The team, we all have responsibilities for different parts of the portfolio. So I pick in North America and the UK, I pick real estate companies, for example, and I pick insurance companies. So, I'm looking from my point of view at those universes of stocks. And hopefully, being as old as I am, I've got a bit of experience about finding, what I should be looking at. So we're all quite experienced on the team at identifying what we should be prioritizing, what we should be looking at. But it's not easy, there's a lot of opportunity out there to consider at any point in time. But we've got good data sources, we've got great information from companies, we've got great interaction with companies that help us inform our view. And in terms of selling, you either sell because things have shot up and they've done really well, in the case of maybe the Max Linear that's done really well and we're taking profit in that, or you sell something because it's going wrong. And I'm afraid there's always a few of those. So we'll always going to be selling things, but it comes down to the individual fund manager, and but certainly not just me, but 9 people on this global small cap team making calls day by day on the things they make the calls on.
Yeah, no, that's really helpful. So there's a few questions about the collectives, the funds that you include. So are you happy in principle to stick with investing through collective funds regardless of BMO's research capabilities, or do you foresee, maybe they're also alluding to the Columbia Threadneedle investments component of now our wider team, will you be able to consider that? And then another question on the same topic is about whether you're going to potentially consider not just geographies for collectives, but also sectors or themes.
Yeah, good questions. I mean, good points. I mean, I think the collectives, as I said on the way through, that this is an actively managed collectives portfolio, so I'm looking at it, all the time, helped by colleagues within BMO, the multi-asset, multi-manager teams here, and and also increasingly, I'm sure, with the Columbia Threadneedle multi-manager, multi-asset sort of people. Yeah, and the question around the Columbia Threadneedle side of things, ultimately, it's relatively early stages in the integration of BMO's global asset management and the Columbia Threadneedle investments business. We're already interacting, but we're not, fully integrated at this point in time. I'm looking forward to, learning more in the coming months about the expertise within the investment team there. And it is possible over time there are things that we can do internally, maybe make use of some the greater internal expertise to pick individual stocks in some of those markets that we're using collectives for. But at the moment, we're going to carry on with collectives until we're confident that that's the best way forward. The sector point, I think, in terms of using collectives for sectors, I have given some thought actually in the last year on. I think, as I said on the way through, we're underweight in North America, very underweight to or non-existent in biotech as an area. Is there a fund out there we could buy which would give us a diversified exposure to North American biotechnology small cap stocks, run by sensible outfit with a good level of expertise towards that niche. Thus far, I haven't found it, but it's possible there is something to be done there. You could say the same about some other individual sectors, but generally, you know, we feel confident in our own ability to pick stocks in North America, Europe, UK. So I don't really want to keep adding more and more collectives. Is the bottom line.
Yeah, understood. Now back to the macro picture. How will you hedge the effects of inflation for the fund?
Oh, yeah, that's a good question. You know, the inflation. I think we're all. You know, we're all still trying to work out. You know, a few months ago, it was, is it transitory or isn't it? And I think we're probably through that phase now. So I think there is definitely a feeling that it's with us for a bit longer. You know, not least because of what's going on in the Ukraine. I don't think we're going to try and hedge. There's no effective way of hedging it. I think the way to hedge it, I guess, is just to carry on doing what we're doing, which is to focus on the individual companies, to look at their ability to pass on costs. You know, maybe look at how they did it in previous years. Certainly at the moment, we're talking to a lot of companies, and we are finding, you know, that they are generally having quite good success in passing price rises down their channels. There's going to come a time where there is resistance to that, but you know, a lot of our companies, you know, we are pleased at the way they're reacting thus far, and you know, we think that the margins will be protected. But you know, ultimately there will be some companies that will have lags in getting that cost recovery through. So I'm afraid there will be some, you know, pressure on some of the companies. Some of the companies we're owning will have you know, squeeze on their profits this year from what's going on, just because it's such an extreme movement up in energy prices and in some other commodity prices. So I'm afraid we can't entirely hedge ourselves away from it. But, you know, again, at the margin, we're trying to tilt the sectors a little bit more to areas that maybe, you know, are better insulated from it, or actually beneficiaries of inflation. So, you know, the banks, for example, have been a strong performance in the last few months on the basis that the interest rate outlook has changed, and you know, they've been long waiting for a better long-term interest rate outlook. So, you know, there are ways of hedging it to a degree, but I'm afraid you're always going to have you know, you're always going to have challenges when you have prices rising this rapidly, and you know, you're going to see interest rates rising probably in North America tomorrow, and possibly another 4, 5, or even 6 further rises later in the year. So that's got to be something we've got to keep an eye on as well, you know, the actual monetary policy outlook. I don't know whether I've said enough there, Christine, or not really.
Yeah, no, I definitely agree. And funnily enough, the next question is kind of tied to this, because Nigel is asking, how do you balance between maximizing the long-term total return and that of short-term performance? And being, well, he's suggesting that you have to reference a benchmark as well.
Yeah, I mean, I think, you know, we always say to people, and we try to be, you know, we try to say to people, this is you should invest in this fund if you like a long-term view, you know, and we take a long-term view when we're buying companies. We're not looking to buy companies on a very short term, getting into something this month. We have not, for example, been buying an oil stock, a highly risky oil stock in the last month on the basis we think the oil price is going up. What we have been doing in energy is buying, you know, at the margin, maybe adding to companies that service the energy market, which are probably going to see a decent sort of environment for their service. But we're not going to try and jump in and out of individual E&Ps, because those stocks are hugely volatile, and getting your timing right is very difficult. So to an extent, that maybe answers the question. We're not really looking to do short term on trading. We're looking to buy companies that we think, you know, we can hand on heart say, in 3 years' time, we think this thing is going to be bigger. It's going to be successful in its industry, and that's what we're looking to focus the investment on at any point in time, let alone inflationary or not inflationary. And you know, that's really not going to change. In terms of performance, I think I worry about performance, you know, day by day, because I have to give presentations about performance to investors and institutions, and you know, the fund does to report its performance every month, and so I worry about performance. But you know, it's you've got to try, and as a fund manager, accept that you can have good times and bad times performance wise, but look to, you know, hopefully over the long term, if you can add value over the long term. Certainly in the small cap spectrum, you've got a better chance of doing that, you know, than you have in large cap equity, as far as I'm concerned.
Yeah. And just to add to that, obviously you have to report to the board and they're keeping a keen eye on performance and obviously representing shareholders' interests as well in that regard. Now referring to turnover of the portfolio, what is the turnover if you have that figure to hand, but then more specifically focusing in on Kirby, which you spoke about, the fact that you held it in the past, exited, and now back in. Have you looked at what would have been, what would have been the effect on the portfolio if you had kept it? Do you ever kind of think back about, well, what's best for the portfolio in terms of buying and selling?
Yeah, I mean, there's again a number of questions there. I mean, turnover, I think we would say that we would have an average holding period of about 3.5 years for a stock. So that would mean, we buy a stock today, then it's probably on average we'll hold it for 3.5 years. Now there will be some companies that we will hold for a very long period. A number of stocks that we owned, we've owned for 15, 20 years on the portfolio, but there will that you just keep holding. But there will be others that come and go quicker. But that does mean sort of, if you like, 25 odd percent in, 25% out, if you like, on an average yearly basis. So it depends how you define turnover, but ultimately, yeah, we would say we're probably at we're probably lower turnover than most small cap funds. Probably be a little bit higher than our average turnover. The Kirby point, I mean, ultimately, yeah, I think we've been in it in my time. I've been here since 1997. This fund, I think, has probably been in this stock on probably 3 separate occasions. I can't remember off the top of my head when those were, but Kirby, I think we bought back into it probably a couple of years ago. It had got out of favour as the oil services market had deteriorated on the back of a falling oil price. It got out quite unloved, but we sort of perceive the value in the franchise they've got. A lot of it is shipping within the Mississippi Basin, going up and down there with product, so we just feel at the moment it's better positioned again, and therefore it's right to be back into it. Now there will come a time where if the share price gets too positive, then we might look to get out of it again. So shares are there to be bought and sold at the end of the day, and we're not averse to taking a profit when we think it's got too far, but. If we'd held it throughout the whole of the period, I don't know. Probably, to be honest, on a 10-year view, probably doesn't look that great if we look back 10 years, because the energy space has been so unloved for a long period of time. It's probably, it's probably not been a great place to be. You've been much better off in tech or healthcare in the last decade, or the more growthy end of the market.
Yeah, great. That's very helpful. Farouk is asking, actually, on the topic of energy, you're referring to fossil fuels, but do you have a view on sustainable resources as well?
Yeah, I mean, so I think like everyone, I'm very happy. I'd be very keen to see the end of fossil fuels, and that everything's renewable. But we are in a world where still, particularly in the emerging market sphere, a lot of dependence on fossil fuel within the energy mix, and so there is definitely still going to be a role for fossil fuel in the coming period. I think what we're going to see as a result of the current crisis is though a faster rollout of renewable energy, solar power, wind power is going to be pushed faster, which is good for the world. But in the meantime, you've still got to have the fossil fuel to keep the world going. So, do we have a view on sustainable? I think our view is, we want to be, we want the portfolio to be more sustainable over time. We've got a number of investments that play to sustainability trends. We were holding a company, John Lang, a couple of years ago, which was doing a lot of investment in sustainable renewables, for example, and that company got taken over. So there are definitely ways of playing it in the small cap sphere. You've got to be a bit careful you don't pay too much, and some of the battery sort of stocks, some of the sort of earlier tech names, they're not the sort of thing that we tend to buy on this fund, because in quite a lot of cases they haven't got a proven history of making money. So yes, we want to get involved with that part of the world, that part of the market, but only when it makes sense from a stock basis.
Yeah, definitely. That makes sense. Probably an indirect link, but this is probably a good time to ask Robin's question. Why negative? Why are you negative on the Lloyd's insurance sector when premium rates are rising across most classes?
Yeah,
Asset classes.
again, yeah, the Lloyd's sector. There's two or three names we can look at in this fund. Really, there's not a huge number of names. I am looking at a couple of them because actually I have derated quite significantly in the last, even in the last 2 or 3 months. There's been a further derating of a couple of the names. I think there is uncertainty at the moment around. Well, the two things I would say is one, I think my enthusiasm for the area has been sapped by about 3 or 4 really bad years of underwriting results from the sector. COVID hit them, extreme weather events hit them, litigation hit them, and it seemed like a succession of bad news in that area. So very poor underwriting returns have sapped my confidence fundamentally. And then more recently, this war situation, and there's talk now building that there's exposure to in the aviation market to losses there, and obviously political risk losses, trade credit losses. So again, there's uncertainty around that. But I am more attracted to the valuation of a couple of those names, and certainly keep it under review, and probably going to interact with companies in the next few weeks, actually. So I reserve the right to do a complete U-turn.
Of course. You're keeping your finger on the pulse, which is good to hear. Marilyn is asking, you were talking about defense. Are you affected at all by ethical considerations when you choose companies to invest in?
Well, that's another good point, because at the moment we're now starting to see already, although we're only about a month into this terrible situation, we're now starting to see a lot of talk in the industry about whether ethical funds should be allowed to invest in defence companies on the basis that the defence products that are being supplied into Ukraine to help protect that country, should they be regarded positively or not? I mean, I'm not going to debate. I've got no better view on that than anyone on this call will have. I think we just feel at the moment that when Germany is doubling its spending on defence, when other European countries are going to do the same, there's going to be a lot of money spent in this area in the next few years. And we bought a holding in Kinetic in the UK portfolio in the last few months. Obviously, Ultra Electronics we did hold, which was on that slide, had been taken over. But there are a few ways of getting some exposure to it in the small cap sphere. Fundamentally, I'd rather the world was a peaceful world and we didn't actually have to invest in defence. But we have to take a view on how the sector's going to perform, and we have some exposure to it, but it's only it's a relatively small part of the portfolio. The fund is not a screen fund, so it hasn't got any restrictions around what it can invest in.
Yeah, that's good to know. There's a couple of questions on collectives from Tom and Nigel, and they're referring to the charges. So what fees that those collectives charge. So maybe in a nutshell, can you talk about the effect of the fees that you have to pay on those collectives on the overall portfolio performance?
Yeah, I mean the charges, these funds do have costs obviously attached, and I think they actually have an average higher average annual management fee than BMO gets on its management of the trust. But broadly, if you look at the cost structure of the fund, we have to basically ascribe the proportionate share of the costs, the management fees on that part of the portfolio. So about 18% of the portfolio, if you like, with an average management fee of about 1%. It works out about 1%. We accrue, if you like, in our own ongoing charges number, 18 basis points. So 1% of 18 times 18%, if you like. And so it works out at 0.18% on our own cost structure within our ongoing costs, which are about 75, 78 basis points. So it's not an inconsiderable part of the cost structure, but we've deemed it to be the right way to go. As I said earlier, we think a number of these fund managers that we're using, they've got good resource in their spheres. They've added value over the long term. So better to use them than to actually try and do it ourselves when we haven't necessarily got the level of resource that they have for finding Japanese or Asian small cap. And As I say, that might change with the Columbia Threadneedle deal over time. We may go a different way, but at the moment we are using them. So that hopefully that illustrates broadly what they're costing within the mix.
Great, and I think this will be the last question. And funnily enough, we haven't touched on Brexit in quite a while, but Mark is asking, probably in relation, in fairness, to global supply chains as well, have you seen much reshoring? Is it happening? What impact does that have on the trust, particularly, presumably, in the UK?
Yeah,
other geographies?
I think reshoring, is a word that's you're going to see more and more in the press, because I think this crisis is already, and I think the concern there is around China, possibly the reaction of China to the crisis. There is definitely a chance that you're going to see some more of a repatriation of production back to not just the UK but to the developed world from China and certainly from Russia. So I think there will be more reshoring. Have we seen a huge amount of it in the portfolio? I'd have to say, to be honest, not massively. The reality is a lot of companies have spent the last 20 years outsourcing to cheaper parts of the world to produce. And, I think what you're going to see probably is you're probably going to see a bit of reshoring, maybe of lighter sort of assembly type operations where so that you can maybe build more of a buffer stock locally. But I think it's too early to say how significant that's going to be. But I think there is a risk that with China, that if China is deemed to be not being being seen to be with Russia too much, then I think there will be companies that are seriously re-examining their involvement in China. But that I think this is playing out in the days and weeks ahead of us. And now, as I said before, we just hope that this war can end as soon as possible.
That's fantastic. Thank you both for addressing so many questions, and thank you, of course, all the investors for submitting those. The team will have the ability to review all those questions submitted there, and of course we'll publish responses where appropriate to do so on the Investor Meet Company platform. Peter, perhaps before we're redirecting the investors to give you some feedback, which I know will be particularly important to you, can I just ask you for a few closing comments, please? Yeah,
I think the only closing comments, I think really, I think we like to think that this is a nice fund for retail investors in particular. We've got about 40,000 retail investors in the fund already, and they hold a lot of them quite young investors through the Child Trust Fund and other sort of the BMO savings platform. But we like to think it's a good fund for people to have in their mix. It gives you a really nice globally diversified exposure to the small cap asset class. I'm a smaller companies fund manager, so I'm always biased, but I always tend to think that in the long term, smaller companies are more interesting than the large cap end of the market. Now, obviously, we've been through a period where some of the gorillas in the large cap tech area have done really, really well for a long term. Those are great businesses, but we do think long term, there's more excitement probably in the small cap spectrum. So I think we try and do a job of picking the right stocks, obviously, with the team we've got and the experience we've got on the team. We hope we can continue to deliver decent returns for investors in the long term, as we have done in the past. So, but I'm not going to say anything more than that. And I do thank all the investors for their attention. I'm very happy to try and answer their questions that we haven't answered on this call directly or via Paul and the team at Investor Meet.
That's fantastic. Peter, Christine, thank you again for updating investors. Can I please ask investors not to close the session? You should be automatically redirected to provide your feedback in order for Peter and the team to better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of BMO Global Smaller Companies PLC, we'd like to thank you for attending today's presentation. That concludes today's session. Thank you and good afternoon to you all.